The last thing we have to do with straight line depreciation is just look at a little bit of accounting theory. So let's just recap. How do we calculate straight line depreciation? Well, we've got two methods. We've got the formula method, and that is where we calculate the depreciation expense per year, and we take the historical cost and less away the residual value, and then we divide it by the useful life. There is another way to calculate it as well, and that's where we give you a percentage. And in that case, the depreciation expense per year is the historical cost, and then we times it by a depreciation rate, say 10%, 20%, 25%, whatever. So that we know. We also know that when we do this, we might get some figures here. So if we took this formula here and we applied it to this van, and we say the van has a purchase price of $48,000, we're going to modify it for $2,000, residual value of 10, which is an estimate, and estimated useful life of 4 years, and we just plug those numbers in. We've got $50,000 cost, less residual value of 10,000, useful life of 4, so that's 40,000 divided by 4, so $10,000 per year. So we've got a figure here. So we've done all that. We've done how to calculate it. We've also done how to record it. So what would happen is in the balance sheet here, we'd have an asset called van under the non-current assets section, and we can think of that as unused economic resources in a big tank, and that would go here. And we also know that we are never going to touch this ledger. We're going to leave it at 50,000 every year, like so. Yet we're using a bit of the van every year. We're going to use some of these economic resources. So what do we do there? Well, we create another tank here of used economic resources, which is going to be an expense, and we're going to call it accumulated depreciation. And every year we're going to put the depreciation in this tank. Not take it out of this tank, we're just going to put it in this tank here. And so for example, it was $10,000 in this case, so it was a credit over here. And this was a negative asset, so it's the exact opposite of an asset like the van. And then what we got here was something called the carrying value. And the carrying value essentially represented the historical cost here less the accumulated depreciation. So this number, 50,000, minus this number, which is 40,000. And what we can say is, looking at the van, had unused $50,000 of economic resources, but we used 10. So the carrying value, or the unused part of the economic resources, is 40,000. And then each year, all we did was charge another 10,000. And the carrying value subsequently decreased by the same amount. So we can see by the final year, $50,000 of economic resources, but we've used 40,000 of them, so that leaves a carrying value of 10. So we know that. But I guess now, and to record that, we would do a general journal entry, so we've done that too. We just go and create an expense called depreciation of van, and then we also have this negative asset called accumulated depreciation, and we do a debit in this one here. And because it's going up, expenses go up on the debit side. And then this is a negative asset and it's going up. We're putting economic resources into this account. So that would go up here, so that's a credit. And then we would match them up with a narration. So the narration here would be depreciation of van, because that's the name of the other account. And the reference here would be accumulated depreciation of van. And then we would do a narration, van depreciated for 12 months. So now I guess we kind of need to ask two questions about the theory. One, why is depreciation an expense? We're just saying it is. Why is it? And two, should we even record it at all? Let's answer the first question. Why is it an expense? And to answer that, we're going to go all the way back to the beginning of the year when we did the definition of an expense. And there were three parts. It's got to be either a decrease in assets or an increase in liabilities. It's got to result in a decrease in owner's equity. And three, it's got to arise in the course of the ordinary activities of the business. So what we say is, for this part, the item has to make either assets decrease overall or liabilities increase overall. For example, if one liability went up and another went down by the same amount, then that is not an expense. It's got to decrease owner's equity. So it can make owner's equity go up and down at the same time. We're just saying overall, it's got to result in an ultimate decrease. And this ordinary activities just means it's got to be incurred through an ordinary activity, and that excludes drawings by the owner. So that's the definition we're going to apply. But before we do depreciation, why don't we just go and look at one we've done for a few months now. Why is rent an expense? So let's take an example. Paid $10,000 cash plus GST for the monthly rent. So we would need a rent ledger, and that's an expense. We're going to need a GST clearing ledger, and that's a liability. And we're going to need a bank ledger, and that's an asset. So the first thing that happens is we've got this expense called rent, so that's an increase in an expense, so that's a debit. We're paying GST, so that makes our liability go down. So when liabilities go down, that's also a debit. And we're paying the rent and the GST from our bank account. So the bank account's going down, so that would be a credit. And we match the references up. We put bank here, and then we'd write rent/GST clearing there. Done. What is the impact of that on the accounting equation? So assets must always equal liabilities plus owner's equity. So why are we doing this? Because we can always tell whether something's a revenue or an expense by looking at it in the terms of the accounting equation. So what just happened here? The asset bank went down 11,000. The liability GST clearing went down 1,000. And owner's equity went down because rent was an expense. And that balances. So assets went down 11. That has to equal liabilities down 1,000 plus owner's equity down 10,000. So that balances. So now we can maybe answer why is rent an expense? So was there a decrease in assets or an increase in liabilities? Well, there wasn't an increase in liabilities because they actually went down. So it's this one. So we would say rent is an expense because the bank asset decreased $11,000. What is the result overall? It decreased owner's equity $10,000 because of the rent expense. And was it an ordinary business activity? Yep, occupying the property to conduct operations is an ordinary business activity. So that is why rent is an expense. So now, why is depreciation an expense? Let's use our example. Charge depreciation of $10,000 on a van. So we had a debit to an expense ledger, and we had credit to a negative asset ledger called accumulated depreciation. So we know that. So well, how does this go on the balance sheet? Well, we know it goes under non-current assets. We put the van, which is the original asset we bought, and that value doesn't change every year. That will stay at $50,000 every year. And then we take out the accumulated depreciation every year. So we accumulate 10,000 there, and the carrying value goes down to 40. Then we accumulate another 10 there, so that's a total of 20. Carrying value goes down to 30, and so on. So what is the impact every year when we do this $10,000 depreciation? Well, what happens is we got assets equals liabilities plus owner's equity. Effectively, what's happening every year is the asset called van, it's carrying us. The van itself here, 50, is not going down. So it always stays at $50,000. We never change that asset. What is actually going down is the carrying value though. And that's what the whole purpose of this accumulated depreciation account. So what we're going to say here is it's the van's carrying value goes down 10,000. So overall the asset went down from 40 to 30 to 20 to 10. So the value of the asset overall, its carrying value is going down 10. And we said that's because we had a depreciation of van expense, and expenses decrease owner's equity. So in this case, assets would go down 10. Nothing would happen to liabilities, and owner's equity would go down 10,000. So why is depreciation an expense? That's what happened there in our accounting equation. Here's our definition. So in this case, we would say the decrease in assets, it's specifically the carrying value of the non-current asset, in this case a van. That's what decreased in this case, and it was $10,000. There was an overall decrease in owner's equity here because the depreciation is an expense. And lastly, does it occur in the course of ordinary business activities? Absolutely, because you need to use the van to conduct operations, and that is an ordinary business activity. So that is why depreciation is an expense. We're going to look at that and just apply our definition here and apply it to the numbers up here. Secondly, should we even record depreciation at all? So when we use depreciation, we said what we're doing is, let's say we got a van, we're going to use it to make revenue each year, and we're going to match an expense to it so we can calculate an accurate net profit. So if we were going to use the van for 5 years, every year we charge $10,000 to match against the revenue from the van. And what we need to consider is, well, what if we didn't charge depreciation? What if we didn't use it? Here's what we'd do. We'd have revenue in the first year of $10,000, but we'd charge $50,000 as an expense because all of it's going to be incurred in year one because that's when we paid for it, and we'd actually get a net loss of $30,000. And then in every other year, we wouldn't have an expense. The expense wouldn't exist because we charged it all in year one, and that's wrong. These profit figures are wrong every year. So that's why we charge depreciation. However, we've got some problems with the formula. So the formulas asked us for historical cost. Now that's no problem because there'll be a source document for that. We can prove that that figure exists. But then we've got the residual value, an estimate of the value of the asset at the end of its life. That's an estimate, and we've got the useful life. That's an estimate of the period of time we're going to use it. That's another guess. And if we use the percentage rate, we've got to, like, where does that percentage come from? We've just been giving it to you saying 20%. Well, who came up with that? So that's also an estimate. So we've got some problems here with these estimates. So what we want to do is kind of consider, well, a for and against, a good discuss question. Should we even record depreciation at all? We'll have 4 arguments for. We could say argument number 1 would be relevance. We need to charge it because we need all information capable of making a difference to our decisions. So what's depreciation got to do with that? We need depreciation because it's the expense of using the non-current asset, and it decreases net profit because we just said it's an expense, and then we can calculate a much better net profit or a more accurate net profit, and then we can make better decisions. We could also say argument number 2 is faithful representation. All the information you publish in your financial statements must represent the real world. So because depreciation is an expense in using a non-current asset, if we didn't include it, our numbers would be incomplete and wrong. So we have to include it so our figures are complete and correct. So they're qualitative characteristics. We could also use a couple of accounting assumptions. We could use the accrual basis. It says we need to calculate the net profit every period by determining the revenues earned by the non-current asset, and then we need to match that with the expense incurred from using the non-current asset, and that is what we call the depreciation. So we cannot fulfill the accrual basis without depreciation, so we need to calculate it. And lastly, we could say the period assumption says don't allocate all of the economic resources of the non-current asset in the period it was bought. That's stupid. We should charge depreciation each period, so we are allocating the economic resources used to its correct period. So 4 arguments for. So depending on how big the question we've got to answer is, we might need to use 1, 2, 3, or maybe even all 4 of those. But then we might need to consider the other side of the argument. On the other hand, why shouldn't we charge depreciation? And the biggest reason is this one, the qualitative characteristic of verifiability. It says all information must be verifiable with source documents to prove it, and estimates and guesses should be avoided. Depreciation completely breaches this. It's got guesses about residual value, the useful life, and the depreciation percentage rate. None of those amounts can be verified with a source document. If we ever need a second argument, what we can do is spin this faithful representation around and going, well, yeah, we do need depreciation because otherwise the numbers are incomplete and wrong. But again, it's still a guess. So faithful representation says your information's got to be neutral without bias. So who's coming up with these estimates? The depreciation involves estimates of residual value and useful life, and these figures are open to being biased guesses which don't reflect reality. So that's probably the worst case question we could get, is having to discuss whether we should or shouldn't record depreciation. So here's all our arguments on one page. So we want to get that down in a table in our notes. And then whenever we get our question, we want to refer to it. And we just need to note, does the question say we have to use qualitative characteristics in blue here, or do we need to use our accounting assumptions there in purple?